Due to the rising trend of the retail apocalypse, more than 800 stores have announced their upcoming closure this year. So what happened, and which ones are they? Let's learn about these 10 big retail stores that are currently closing stores. Designer brand stores. The days when your footwear was making a fashion statement are long gone. In an era of online meetings and get-togethers, very few people are buying them. Designer Brand, which owns businesses like Kamuto Group and Designer Shoe Warehouse, have come to a decision to close almost 65 of its stores in the next 4 years. Its sub-brand, Designer Shoe Warehouse, was founded in 1991 and has over 550 stores across the US and Canada. The company had mentioned about 24 stores to be good candidates for the decision back in 2021, but it is unclear about which brands were on the chopping board. Fry's Electronics. After being in the business for over 36 years, Fry's Electronics finally got out of the game. Fry's Electronics was founded in 1985 and offered products like home appliances, toys, software, hardware, and cosmetic items. The company has taken this drastic measure as a result of the challenges it had to face during the COVID-19 pandemic. This has forced it to close all 31 of its stores across 9 states. Macy's, another beloved departmental store that was popular in the 2000s, is nearing its end due to the high competition with digital shopping websites. The store has given an official decision to close its stores back in 2020. They had announced plans to take down 5 of their stores and lay off 2,000 employees in a motive to improve productivity. In an earnings call, Jeff Gennett, the CEO and chairman of the group, claimed that he wanted to experiment with small stores outside of big malls. According to CBS News, 29 of the 125 expected closures took place in 2020. The retailer announced the closure of 6 additional locations last year in Alabama, California, Colorado, Missouri, Texas, and Florida. Store closures took place during this quarter in California, Colorado, Maryland, and Hawaii. Those in Kaneohe, Gaithersburg, Fort Collins, and Los Angeles are included in this. CVS Pharmacy. If you didn't know about CVS, it's the largest pharmaceutical chain with nearly 25% of the market share based on prescription drug revenue. The chain plans to close 10 more locations, making its total closures to 900. The CVS chain has been gradually closing stores in cities including Johnson City, Tennessee, Falls Church, Virginia, and Fresno over the past few months. Too many CVS stores, in Neil Saunders' opinion, are stuck in the past with subpar lighting, dismal interiors, messed up merchandising, and a small selection of goods. It's anticipated that the closures will free up the chain to make investments in its surviving stores while bolstering its quickly growing online presence. PaperSource. PaperSource, once a renowned greeting card company, recently filed for bankruptcy in 2021. Founded in 1983, they sell party supplies and gifts, as well as stamps and stationery items. It had planned to close almost 11 of its stores when it tried to secure rental subsidies and assess other potential locations for closure. Their decision comes a year after Carlton and Papyrus Cards have landed in the same place. The Chicago-based retailer was planning to expand its business after acquiring 30 more stores. However, their sales soon began to decline, and PaperSource landed the same fate as their rivals. JCPenney. This departmental store has been functioning for over 120 years now. In the spring of 2020, the company had filed for bankruptcy even before the beginning of the lockdown due to years of declining sales, and it had to close almost 30% of its locations. Later in December of the same year, several mall owners such as Brookfield Asset Management and Simon Property Group swooped in to acquire JCPenney, rescuing it from financial ruin. Over 170 stores of the retailer have been chopped off last year, and there were plans to take down 90 more in 2021. According to CB Insights, the corporation has been losing money since 2010 and has accumulated net losses of $4.5 billion. The corporation has been forced to recognize its debt and close more than 200 stores. Additionally, shops in Elkhart, Indiana, and Oswego, New York are closing their doors this spring. Bed Bath & Beyond. You may know this retailer as a supermarket for home appliances, but that's not what they have to offer. You find anything ranging from candles to couches at Bed Bath & Beyond. In 2020, the company announced it would close almost 21% of its outlets in Canada and the US in 2 years. That counts to over 200 stores. Due to its e-commerce flaws and supply chain disruption, it has recently been unable to keep up with consumer demand for online shopping. Considering these difficulties, the CEO, John Hartman, has announced to make some changes in their strategy and is planning to bring it to an online platform. To reduce costs in the face of rising supply chain and transportation costs and rampant inflation, the company has announced plans to eliminate 130 corporate roles. Best Buy. With their online platform, they are short of investments in their physical outlets. Due to the lack of customers coming in, the management has planned to shut at least 20 of their outlets to reduce costs. During an earnings call conducted last year, they announced the closure of their outlets at 20 locations in a span of 2 years. It also plans to lay off 5,000 employees, even though 2,000 are registered as part-timers. According to many retail analysts, the corporation may completely disappear from the US retail industry before the middle of 2024 as a result of its plan to prioritize online sales. GameStop. You might have already heard about GameStop in the news last year. It's a name that has made headlines related to their stocks hitting the new top. But in reality, the retailer has been shredding hundreds of stores over the last 2 years. In 2021, they announced their plans to shut down stores in over 1,000 locations. With the gaming industry booming and increase in the convenience of digital downloads, GameStop is not making much from its outlets. True Religion. True Religion, once a leading retailer in the premium denim market, announced that the company joined the retail death march by July 2017, filing for Chapter 11 bankruptcy protection. Founded in 2002, the company grew swiftly and built a business based on high-end designer jeans that cost $200 to $300 or more. Towerbrook Capital took over True Religion for a whopping $835 million in 2013. However, things shifted in the opposite direction, with the company losing $78.5 million on revenue of $369.5 million in its fiscal year ending January 28, 2017. What could have gone wrong? The market evolved, and True Religion failed to adjust its prices to match consumer expectations. What possibly might have changed things? Knowing what the customer wants in terms of design and what they are willing to pay for it. But sadly, the time has passed. It is hard to see some of these retail shops that have been functioning for years getting shut down due to the pandemic. It's high time they realize that online shopping is the way to go in the future, and more people are adopting online shopping trends. With that, we have come to an end. If you like this video, then make sure to share and subscribe to our channel. To see more of our videos, click on the links you see on the screen. We will be back again with more. Until then, see you.